All right, so today is a different kind of video. As we're seeing, this equity is getting around 4,200 in the S&P. It is getting hard to convince that given everything as picked, how can we get return out of the equity? And if you already have good amount of asset or cash in hand, how do we ensure that you preserve this cash and generate some income without losing the principal? So the only way to do that is using the bonds. So in this video, we're going to look at some of these bonds, LQD and HYG, mostly on the HYG right now, and see that bonds which are maturing in the next 4 to 5 years from up to 2027, whether we are getting some 3%, 4%, 5%, or up to, in some cases, 10% interest in LQD, which is high quality corporate bonds. We're getting 5%, 6%, 7% interest. We're going to filter those and you're going to see that if those are good investment. So what I did here is I went to my Bloomberg terminal and I looks like that crashed. In Bloomberg terminal, I just extracted the LQD and the HYG, these two ETFs, the bond ETFs, which provided like all the different composite individual corporate bonds that is creating that is making up that specific LQD or HYG ETFs. So here we have two tabs. So you can see that on LQD we have about 2610, something like that, 2610, those many number of bonds, right? And each of them has their, in the column B, you can see that 4.9% for this company. I mean, most of these companies, they're so diversified that, if you just do LQD, buy the whole ETF, you are going to get around 3.94% of the dividend yield. Whereas if you choose the specific companies, here I have broken it down. For example, this is the bond name, ABIBB, 4.9% is your yield, or the or overall the coupon. So if you buy a bond of this, right, for 9,000, so you're going to get a $490 of face value. So for example, you might get, you can see it in two ways. One is that you put $100 on it, you get $4.9 every year as a dividend. Or you can say that, okay, I'm going to buy this bond for 90, what is it, 100 minus 4.9, which is 95.1, and I'm going to get back $100 out of it. So that's kind of the contract between you and the bondholder. So here, what we're trying to do here is that we're extracting this ABBIB, for example, is one example, like, of all these 2,700 bonds we saw here, where we are getting 6%, 7%, or 8% coupon. This is the highest for the LQD, 8% coupon. And that's how we're going to kind of see that true or false here. If it's 6%, then you get a true here. And then, if it's, for example, 8%, you get a true here. Why both of them are true? So there's this error here for this. That's why it is true. So anyway, and then we can kind of check that the error is that it's actually extracting 0.6. That's why it shows true here. So but it's also showing true for 8% coupon. So this is the valid one, Deutsche Bank's. Now the third thing we're going to do is that is it maturing in the next 4 years, right? 27, 26, or 25. Within the next 4 years, is it maturing? If you're maturing less than 25, you're not going to get 6% interest rate for this. So and then based on that, the final column H shows that are we getting a 6% plus yield within the next 4 years? If this is true, then we recommend to, or we have to look at that, okay, if that is something that you would be interested to buy, right, those bonds based on multiple factors. So this is how we can do that. LQD is a more high quality companies, whereas HYG contains both high quality as well as some of the junk bonds, which is basically high yield government and corporate bonds. So that's what basically HYG kind of stands for. So here we can see that in HYG there are more green numbers here because it contains mostly the high yield bonds. So there's like a more instances where you can see that the 6% coupon, uh, or 7% coupon, or 8% coupon, even in some cases 11, 10, or 12% coupon available. I don't think there's any of them has 13. There's some couple of them also have 13% coupon available. So this is the video that kind of I'll share this video, the spreadsheet in the video link, and then you can sort of extract. So for color coding them, so true as green means that this particular column C is true. So that means this particular bond, let's say Goldman Sachs, which is maturing in 2037, is giving you 6.75% of dividend, or rather the coupon every year until 2037. But we're not interested in this specific one, so we're not going to mark this one as with any color. We'll say it's false because it doesn't meet the criteria that within 4 years it's giving 6%. It's giving 6%, but it's not maturing for 2037. What that means is that if you are buying this bond, you're stuck with that money for until 2037 if the interest rate goes up. So let's say the interest rate goes up further for the US government treasury bonds from 5% 2 year to 6% for 10 year. So this is following, this 37 would be following let's say 10 years or 20 years of the US treasury. So if the market, the overall economy continues to be good, and Fed continues to raise the interest rate, then the current 10 year at 3.5% would be touching 4%. As it does, then this particular bond would be then losing value compared to treasury. So this would be actually cheaper. So because people will sell off this bond to buy the other more safer treasury bonds. In that case, what will happen? So this will lose value. So you're stuck with a lower value. Although you're getting the 6.5% interest right out of it, like $6 of every $100 you invested continuously until 2037. There's a fixed income bond. However, the value, if you want to sell the bond, sell the principal amount to gain some capital gain, you're not going to get it until the the bond picks up the value. That means the interest rate of the 10-year goes down. On the other hand, if the interest rate of the 10-year goes down further from 3.5 to 2%, then this becomes more attractive because this is giving you 6% versus with a relatively low risk versus the US Treasury. So then the price will go up. So that's how the price, the bond price gets adjusted. So you can get your money is secure, specifically for the companies where it's very low chance of going bankrupt. However, your money is also stuck, although secure, it's stuck, right? But if overall interest is in recession scenario, if the bond, in case like we're seeing that people will flock to the bonds because in recession scenario the stocks will be getting punished and we don't have visibility when you come out of the recession. In that case, the bond price will appreciate. As the bond price appreciates, so as the bond yield falls, so we'll see, because we'll see that this bond also will get capital gains. So that's why it's attractive right now in this scenario that you get your money is saved. If you do not have to take out the money in a worst case scenario for 3-4 years. So in this particular case, you have to keep the money for 14 years, in this bond. If the scenario is really, if you are if you're seeing that the stagflation kind of scenario. However, and you cannot get the money out because bond price got so much badly hit that the interest rate goes so high, the bond price gets so much badly hit that you cannot get out of this particular security. But if you take like a medium to short-term risk, for example, the things which are maturing within 4 years, then your duration risk is lower. Whereas you can still, if the economy goes down, then or rather you have the recession sort of scenario, then you can make capital gains. So that's why we're targeting all these bonds from this list, which is 6% plus yield and maturing within 4 years. So you have to look at which ones actually has this This purple lines, this purple line means that this condition is true. That means it's maturing either in 2025 or 26 or 27, and it either has 8% or 7% or 6%. For example, in this long 30, Dell Incorporation, Dell International LLC or EMC Group gives you 6.02% coupon maturing in 2026. That's why this is true. So this is one of the bond you can buy if you want to get a 6% income. So for every $1,000, you get a $60 income. Every $100,000, you get a $6,000 income every year, and your money is safe. And if you don't lose this money, and you get your money back in 2026. So you put around $1,000 at $100,000 there, you get around $18,000 from here. So that's kind of like the whole point here, and this is basically LQD, and for HYG the same scenario. Here you can see that the column D, if it is true, that means this meets the condition. Now HYG is a little bit higher risk than LQD. LQD is very high quality. That's why you can see that well, there's a 2,600. So well, I mean, LQD also include the government bonds, and it's not necessarily all of them are like 2,600 companies. Some companies have different maturity dates, so that's kind of composites this. So if I kind of go for the unique values here, let me see that how many unique values we can kind of get from here. Maybe. Yeah, we can kind of take a look later, but basically it will probably be not more than maybe 200 companies, whereas HYG is probably more than that, and it has 1,200 companies here. It is all high yield, so it does not have mostly the companies which is like less than 3% yield. It has most of them are like 4, 5, 6 or higher yield. Some of them even higher. So here you'll see a lot of those are a lot of those are meeting, like compared to the previous one where out of 2,600 bonds you only have barely 5 or 6 meeting the conditions. Here you have probably 30 or 40 are meeting this condition. So D, where within 6% plus yield within 4+ years, right? So you're seeing that some of these companies you never have heard about it. At least I haven't. So the risk is a little bit higher. So now next part is that to investigate on these companies where this column D is true, and see that if the management at the bankruptcy risk, for example, if I'm going to buy a commercial real estate related company's bond, then it is high risk at this point because the company might very well go bankrupt in the next couple of years. So that's the consensus for some of the companies. However, if I'm buying an Apple bond, it's most likely will not, right? So those are the things that you need to research on the column A, where the column D is true. And then you can even further look at like if any of those companies providing like 10, 12, 13% of those interests, those are most likely in the junk bond categories, but that doesn't mean that those companies are bad. Tesla was a junk bond a couple of years, 3 years ago. Now it is grade B. So Moody actually rates each of these companies with their AAA, triple B, etc. rating. So Tesla is a triple B rating, I believe, right now. A few years ago, it was junk bond. So some of the junk bonds will give you good interest rate, but not necessarily they're low risk. So if you can choose the right junk bonds, and if you can choose that those are maturing within the next 40 years or 5 years, it's a fantastic way to generate income. And as the the company becomes like a double B, they obviously will be setting less interest rate, right? So that means that bond price would be much lower at that point. So the bond price will go lower, much higher, and the interest rates falls. So that means that your bond, which actually you captured for that same maturity date at much higher interest rate, will be worth much higher. So you can sell your bond at much higher rate. So picking up the junk bond for the right companies with a high yield and maturing in 3 to 4 years is a fantastic opportunity to get both capital gain as well as get a fixed income. So that's why bond market is much more safer if you can do your own research Stock can jump much higher, much bigger, but stock also has a high potential of losing money. Whereas bond, your money is secure if you can take the duration risk, which means that you have to hold your money for that long period of time. However, other than that, the bond would be mostly secure. So the tax and others is not considered here. So these are all taxable. If you look at the municipal bonds, then the only way you can actually get better capital appreciation on the municipal bond if the tax in that for that particular state reduces. If it reduces, then it's actually you're going to get higher interest rate. Otherwise, not. So that's kind of like a quick video about looking at the bond. So you look into that. I'll share this video in the YouTube, share this spreadsheet in the YouTube video link, and that hopefully will give you a good context that how can you dip your toes in the bond market if you're a newbie in the bond market. Okay, thank you.